The Future of Money, Governance, and the Law is hosted by the Government Blockchain Association, a worldwide community to connect, communicate, and collaborate. This show is produced by Podtex. To learn more and how to host your own show, go to www.podtex.com. Podtechs. Podtex, your partners in podcasting.
So the theme of this presentation is figuring out how to leverage the tax code to get cash back into your business. Now, because of COVID-19 and because of the CARES Act, there is a lot of new opportunity opening up, and it's changing every day. The information is coming out really fast. So I'm sure a lot of you guys are familiar with the protection program. We are going to just hit that a little bit. And you may be familiar with a variety of the strategies that are talked about here, but it's really bringing these all together and figuring out how they can help a business solve their specific goals and really be catered for each business. So these are the four areas we're going to be talking about. Research and development tax credit, which is a huge area of the tax code that more and more companies are taking advantage of. We'll go through that. Cost segregation studies, which deals with accelerated depreciation of property. IC DISC, which is a good deal for people who are exporting overseas. And then we'll hit a little bit on the CARES Act and some of the stuff that's coming out that's pertinent to businesses and taxpayers. So we believe that these strategies, not only do they offer access to liquidity, but you can reinvest them in your companies. And that's what we have seen traditionally that our clients do. We come in and save them money. They invest in employee training. They invest in exploration of new areas. They invest in jobs. So, at the same time, they're looking good to their investors.
So, Brian, this is Andrew Sr. What we've seen, Brian, like in what you do, when you're going in and you're doing your M&As, we can certainly change the EBITDA or the various multiples on the particular balance sheets that you're looking at by using these strategies to position them to, look better to buyers. Or we can go in and a buyer could get a real more representation of what they actually are buying by using some of these tax strategies, as well as we do fixed asset appraisals and so forth for them. Does that make sense?
Yeah, I think Gerard put folks on mute. So by the way, just a little bit, let me back up. The company Dilligentiam was founded by Andrew Parrish Sr. and his partner. I'm Andrew Parrish Jr. We're both going to be given portions of the presentation. So Senior, you good to move on?
Yeah, I just want to tell you what you're going to see here. This is the third major downturn that I've lived through with this company. 2001, 2008, and now this COVID here in 2019. And the tax code and these programs are heavily relied upon by small businesses to get cash into the door. And the federal government has done this in each one of those. So they're totally focused on using the tax code to get more cash in the door for these businesses. This is something that the federal government wants to happen.
Some of the things in the new CARES Act deal with net operating losses. They are, and when the Tax Cuts and Jobs Act was passed, they limited net operating losses to 80% of income, to only offset 80% of income, and they prohibited carrying back NOLs. One of the major new things in the CARES Act is that this has been suspended and companies can now carry NOLs back 5 years. So this is designed specifically to let companies access liquidity immediately. So that's one thing we're going to be talking about here. Obviously, it's pretty easy to be pessimistic about the current economic situation, but we're trying to look through it a lens of optimism. And like we were talking about, Brian, when you were describing your company, there is going to be a lot of opportunity out there. The slide starts off, when one door closes, another opens. We don't know what it is right now, but there's going to be a need for America to do what it does best, which is innovate and perform R&D to solve problems, right? So, we've kind of identified a confluence of factors that will facilitate this opportunity, right? New problems will need to be solved through innovation and R&D. Before we started this presentation, for those of you who weren't on, Brian was just telling us about how his company is using their AI-based learning software to retrain folks in the new economy. So stuff like that. Obviously, in manufacturing, in software development, they're talking about all this contact tracing, and there's going to be a massive need for data analytics and potentially, blockchain type solutions to secure all this data that's going to be passed back and forth. So there's certainly going to be opportunity for new companies and for companies to shift capacity to solve new problems and thus pursue new revenue streams. The tax code right now is at its best point in a long time to help small businesses and entrepreneurs. We're going to talk about that. As we talked about, the CARES Act has kind of, one, offered a stay of execution by allowing people to not have to fire folks, right? And two, has offered new opportunities through these Nol Carry Backs. One thing we've also seen, not to get too deep into the last recession, but as a result of the last recession, banks underwent severe regulatory restructuring, and they're required to keep ratios that have actually made their balance sheets pretty healthy. They're sitting on a lot of capital reserves. And there was a Barron's report that came out last week that said we've seen U.S. banks increase their lending by 15% at the end of March. So my hypothesis, and it's not mine, it's others, but the hypothesis is that banks were the culprits in the last recession, and they're going to be willing and dying to help in this recession. So that's another opportunity. And we're not going to really get into banking. This is going to mainly stick with the tax code. So the first area we're going to talk about is these research and development tax credits. Now, just from talking to Brian and talking to Gerard about some of the folks who were invited, this is an area that any technology company should be looking at. Start with the basics. What is an R&D tax credit? So a tax credit is a dollar-for-dollar offset of tax liability. And this is going to allow companies to allocate what are considered qualified research expenses in connection with qualified R&D. So there's a bevy of tax code and tax court rulings governing what constitutes R&D for purposes of this R&D tax credit. This sentence right here attempts to boil it down. All a company has to show is that it undertakes efforts to develop or improve a product or process that requires elimination of uncertainty through trial and error experimentation and relies on principles that are technical in nature. Those bolded words are the key. They're called the 4 gates, and we're going to go into that. So essentially, as long as your company can prove that you pass these 4 gates, you can take various expenses and investments towards this tax credit. Generally, this tax credit, for every dollar of qualified research expenses, you're going to get about 10 cents in tax credits. So that means if we find that you have $1 million of qualified wages and contractors that are working on this new software technology, you're going to be able to get $100,000 roughly in tax credits. And so if you owe $100,000 in taxes, you now owe $0 in tax. So it's quite valuable. So just some quick usages that are helpful. This tax credit does apply for startup companies. Big question we get is, I have a startup, we don't have a profit. This doesn't really benefit me. And, not only can you carry tax credits forward for 20 years, but you can now, as of 2015, if you're a qualified startup company, which means less than $5 million in average revenues and less than 5 years old, you can use R&D tax credits to offset your employer portion of payroll tax up to $250,000. So if you're a startup, you might not have taxable federal income, but you probably do have payroll taxes. So this can be used to help offset that payroll tax burden. It's used for corporations to create more value for investors. If you have a tax credit carry forward, that improves your balance sheet because it can be a deferred tax asset or a tax receivable. So that's increasing the asset side of the balance sheet. For pass-through companies, a majority of American businesses are pass-through entities, meaning they're either partnerships or S-corps where all the profit and losses flows through to the individual owner. So these tax credits do flow through to the individual owner. So it creates direct value for the shareholders of a pass-through entity.
You can also get a check from the Treasury company against as a refund against those taxes.
Right. So one thing with tax credits and any tax return, you can amend the prior 3 years, right? You can go back and amend. So say, Brian, you started your company in 2018, you want to claim R&D tax credits for 2018 and 2019, but you've already filed your 2018 taxes. You can go back and amend and claim R&D tax credits. And if you paid, you can use these R&D tax credits to get a refund for taxes that you would have paid. So it's very beneficial. You can actually, like Senior said, you can be getting treasury checks back. Okay, I just want to talk about how a company knows that it will qualify for this tax credit. Again, we're getting into that 4-gate test. So I'll just go through these gates real quick. The first gate is business component. You have to show that you're working to develop a new or improve upon an existing product or process. So product could be software, it could be better mousetrap, it could be anything. Process can be manufacturing processes, plant processes that are needed to figure out how to produce the better mouse. So this also applies to companies that perform services. So if you're an engineering company and you work under contract with, let's say you're an architect, you work under contract with a building owner. As long as you meet certain stipulations in that contract, meaning mainly that you're working under a fixed price, there's some sort of financial risk for you if you fail to produce adequate research results, those services could still qualify as R&D. So this is how we work a lot in the engineering field with people who are, getting contracted under a fixed price contract to come in and design a building, and they claim the R&D tax credit because they have to work under that fixed price to create a successful result. So the second gate is called Elimination of Uncertainty. You have to show that there was some uncertainty or challenges that you encountered to take your product or process from concept to completion. Generally, anybody who's developing something technical is going to be facing uncertainty. You can't say that, we knew the way we were going to do this and it worked out for us really well. You have to be able to show that there were hiccups, that there were bumps along the way. And importantly, you have to show that you evaluated alternative approaches or alternative designs, alternative architectures, alternative code syntax structurings to create a successful result. The third gate is you have to show that you're doing a process of experimentation. Now, a lot of people hear this and they think, I'm a small company. We don't have like a codified process. Really, all they mean by experimentation is you have a system by which you evaluate alternatives to solve problems. It could be basic trial and error, and we'll get into some more examples of experimentation in later slides. The last gate is that the work has to be technical in nature. So it has to rely on computer science, biological sciences, engineering, chemistry. That gate should be pretty self-explanatory. It's not geared towards work in the social sciences. It's not geared towards aesthetic work or stuff that's done for taste or cosmetic. So that gate is usually pretty self-explanatory. So again, if your work can pass this test, you should be using this credit. Okay, so qualified research expenses. What actually gets claimed as part of this R&D tax credit? One is the wages of people that are performing the research. So these are wages of direct engineers, so people directly doing the research, people supervising the research, so that's your managers and C-suite, and people supporting the research. So that's how you get folks that maybe are on help desk, but come in and do some alpha testing or hands-on user testing to provide feedback. That's a supportive research activity. Supplies and materials that are not subject to depreciation, so that get expensed, can be claimed towards the credit. They generally have to be associated with developing a prototype. Contract research expense. So if you're paying a contractor, a US-based contractor, and that contractor is performing or participating in your R&D, you can take 65% of that expense that you pay to the contractor. In the software development field, obviously, a lot of people have been outsourcing to Estonia, Eastern Europe, India, China, the Philippines, even Costa Rica we've seen. So, if you're outsourcing directly to an overseas company, that's not a qualified expense. As long as you're paying a US-based entity, though, then you will be able to take that contract research expense towards this credit. Another thing that's not on here is cloud lease costs. So Obviously a lot of things are done on virtual machines in the cloud. Any money that you're paying to Azure or AWS or any other cloud service provider, any money that is associated with development and testing space, not production space, that's important. It has to be development and testing space. You can take that money towards the credit, right? So all of these things get added up on what's called a Form 6765, which gets filed with your tax returns so that you can claim the R&D tax credit. So the R&D tax credit is an actual stimulus in that every dollar of credit creates a dollar of research spending. That's, study by a think tank in DC. It helps create and incentivize companies to create high-paying technical type jobs. It allows companies to, move money around and plan by, your eliminated tax is obviously a huge part of a company's financial planning. So being able to mitigate that or eliminate some tax frees up a lot, downstream on the financial statement. And, in general, the government wants to encourage companies to invest in solving problems in R&D here. In the 80s, when this tax credit was created, we had fallen behind the world in R&D. And so a lot of other countries have this incentive. These are just some examples of areas that require experimentation with alternatives. So testing alternative materials, alternative assembly techniques. I'm not going to get into all of these, but through various disciplines, people are testing alternatives, whether you're an architect that's looking at alternative revisions or a software developer that's looking at alternative ways to structure this algorithm to, improve speed and get an accurate processing output. So experimentation, again, a lot of things qualify as experimentation. Software companies that are using any of the various methodologies, Scrum or Agile, anybody that has some sort of laboratory process, if you're using CAD or BIM, building information modeling to produce models that get presented to the client and constantly revised, that's all experimentation. Okay, so that's the R&D credit. Again, just the highlights. This is a dollar for dollar offset of tax liability. Companies like us, what we specialize in is coming in and being able to identify qualified research expenses under the bevy of tax code and tax court rulings and take those qualified research expenses and fill and complete this tax form so that you can obtain the credit. Anytime we claim a qualified research expense and R&D credit, we develop a report that backs up legally why a company is entitled to take this tax credit. So, it's a pretty complicated area, and we come in and essentially make it pretty painless for companies to identify their areas of R&D and help them get this tax credit. That kind of wraps up that end. I'm going to kick it to Andrew Sr. to go to the next bullet, which is cost segregation.
Okay, thank you, Andrew. So the R&D tax credit is a lot of times the initial study is for your current year, as well as the 3 open years. Those are the 3 previous years. And when you lump all that together, and a good mid-sized company, around 10 million, say, their credits are running well over 250,000 and up. So it is a real good benefit. Now, cost segregation was used a lot in the 2001 downturn from 9/11 and really was expanded tremendously right after that for that purposes and has been doing very well for people now. Cost segregation is really what it breaks a building down into various components that you can accelerate the depreciation. And the depreciation is a deduction. So where the R&D tax credit was a dollar for dollar credit that you could get, and if you're a pass-through entity, that credit would go right through to your personal income taxes. This is a deduction, so what we create here and appreciate in the deduction, you have to multiply it times your federal and state tax. So if we created $100,000 or $1 million, say $1 million, you would get $400,000 in actual money. So not everybody owns a business or a building, but the building, it can also apply for improvements. Many people make improvements in a building, so this also counts as well. So Andrew had mentioned the net operating loss. So what actually occurs is that we create a loss for a business because this is a deduction. We go in, if they own the building or if they made improvements to the building, we go in and we can use the tax code tells us what we can accelerate and what we can't accelerate. And we put this into a report. Everything that the IRS wants, they want a report and they want documentation, and they will review it. A certain small percentage of them will be reviewed. And we include assistance and working with the IRS in case they would review in the R&D tax credit or the cost seg. So as I mentioned, it's existing buildings that were put in service after 1984. Any building 1984 and prior cannot apply. So put in service means when you buy a building or build a building and you put it on your books. That's when you put it in service. Any recently purchased buildings, any new buildings, or any improvements made. So what's actually occurring here is finding money in the walls. The walls actually in a building can be accelerated. So here's a few pictures of what can be accelerated. If you look at the top left-hand corner, all that decorative shelving and all that decorative railing and the lighting associated with it would be put into an acceleration category. And when we say acceleration, that means we move it from 39 years, which is what they call straight line depreciation. We move it from 39 years to 5 or 7 years. So that 5 or 7, so we're just advancing that and letting you get that deduction sooner than later. Instead of taking 1/39th, you can move it all into 5. And so under these times, instead of, they've advanced it even more. Instead of putting it into 5, they're actually allowing you to do bonus depreciation to take it all this year. So this could be a significant amount of losses that can be created, and you can then carry them back to years where you've paid taxes. And the last few years have been pretty good, and many people have paid taxes. So we can carry this loss back and get a treasury check. And believe me, I did this in 2008. I've seen people cry when they get their treasury checks. It really does create good liquidity. Back in 2008, no banks were lending, so this was really one of the only ways to really get liquidity into your business. So Andrew, if you go back to the other slide, I just want to take them through a couple of those pictures. If you look below the top left and you go in there and you see that hallway, you see all that molding and trim and those lights, all that can be accelerated. That's all decorative millwork. So what we do is we go in and measure that, and we quantify that and put it in a report, and we add a value. We have a software package, we add a value, and we total this up, with the lightings and so forth. In the middle picture here, these glass doors and walls all could be accelerated. Those cubicles in there could be accelerated. All that recessed lighting, which is unique for that, and it could be LED that is unique. All those lightings for those pictures to the right, all that is accelerated. So there's a lot within a building we can accelerate. And if you see the office, the next building to the right, that is a dome. We see lots of these in a lot of the old hotels and the old bank buildings. All that glass, all that ornate trim work, railing, and so forth is accelerated. And then here's a nice office. We see a lot of boardrooms that have a lot of good paneling and molding and so forth. All that paneling, molding, carpeting, all that can be accelerated for 1 year bonus depreciation. So that gives you an idea. To do that, we have to really go ahead and measure it. The IRS is just not going to say, oh yeah, this is the value. No, we got to go in and we got to measure it. We got to tell you what the square feet is. We got to tell you what the price per square foot is. We got to tell the IRS is that. We got to tell them that. Now, what's very important by building these schedules is that if you were to remodel that office that you just saw, you would be able to expense whatever you tore down in that office because you've done a cost seg study. So without that cost seg study, whatever you tore down in that office would be stranded on your books forever, and you would never be able to quantify it and expense it. So you would be losing the benefit of the expense. So here are some typical things that go into the 5-year life. Electrical outlets on non-weight bearing walls really, represent a lot of money, and I pointed it out, but you can see fixtures, millwork. I've talked about some of this. Non-structural walls. There's a court case, the Hospital Corporation of America, who had many hospitals and medical buildings. They were constantly, every couple years, a new doctor would move into an old space and they would redesign and tear it down. All those walls that they built were stranded on their books. So they brought a case against the IRS and won, and that's essentially allows us to take non-structural walls into 5 year, by moving it into 5 years, we're actually moving it into a category like a computer, like personal computer equipment. So this can have significant impact for a company that is suffering right now or looking to get cash in, or even if they're looking to sell their business, this could have some certain impact there as well. And if a company's looking to buy a business, that means that this building will be put in service and that will start all over again. And that will be a deduction on the new owners. All right, so that was the 5-7 year. That's the bonus. This is also part of the bonus. This is very aggressive. First time you can actually take land improvements into 1 year bonus depreciation. And now land is not depreciable. So, but you can create a category called land improvements or land account. And what you put in that account can be depreciated and accelerated. So that was a pool. If you can go back to that, Andrew, that was a pool, and you can see the pool sidewalks, all that shrubbery from on the outside can be accelerated. All those trees, all those plants and so forth can be accelerated. Parking lots, the top layer of parking lots can be accelerated. The lighting within parking lots can be accelerated. So there's usually a good amount of stuff within a land account that we can accelerate. Okay, Andrew, thanks. What we have to leave in the 39.5 year category. So by the way, it's the non-accelerated categories are 39.5 year for commercial buildings and 27.5 years for residential, commercial residential, and that could be apartment buildings and so forth, and hotels and so forth. So the roofs, the walls, all weight-bearing outside walls, you would not be able to move forward. Here's an example of a building that we did recently. It's a $17 million building. The bonus depreciation 5 to 7 years was 1.7 million, plus the property deduction was 170K. So they got a total tax savings and bonus depreciation this year for almost 2 million, 1.9 million. So this is a bigger building, but we do this for $1 million buildings, 1.2 million, 1.3, $500,000 buildings, 500,000 improvements. If you did a series of improvements, you can accelerate that, and that's certainly bonus depreciation. So in tough times, the government allows the cost segregation study to be used widely and broadly to get treasury checks and to help people. So it is certainly something that should be considered in their strategy if you own a building or if your business has paid for improvements. So the next one is the IC-DIS. This is another part of the tax code. Andrew, you can go to the next one. This is called the Interest Charge Domestic International Sales Corporation. So this is for a company who sells goods or makes goods and sells them overseas. So this is an excellent program, very underutilized. What it really allows you to do is to set up a separate company, and that company can be in the United States or it can be overseas. It has its own books. It has its own federal ID number. You have to put some capital in, but what you're doing is that company is the sales commissions that company gets for selling goods overseas can come to that company in a form of commissions. So I am a company, a manufacturer. You can say like US Solutions, they make Rubbermaid. You can basically sell products over into Europe, around the world, which they're doing because of COVID, because their stuff is used for storage and so forth, they can set up a company that sells them for them that they will pay commissions to. There's a tax advantage. Andrew, go to the next one. There's a tax advantage for that. And I'll get into that in the next slide, but just to let you know, there's 304,000 businesses in the United States that sell products. 298,000 are small businesses, and only about 6,000 people are using the IC disc. So it's a very underused area. And of course, it requires documentation. So why would you want to set up and pay commissions to another company? Because the tax code will allow you to take those commissions at a lower tax rate. If you were getting paid, your commissions would be paid on ordinary income, which could be, 37% or even higher. I was talking to some people today, it was even higher. Instead of getting taxed at 37%, you can get it taxed at a capital gains dividends rate of 15%. So you get a net tax savings on that income of 22%. So that's a significant amount of savings if you're doing 500 million or $1 million of international sales, or even 500,000 people are doing this. And what a lot of people are doing and are beginning to do is that they're beginning to set this new company up in a trust. And that trust is going to be part of their exit strategy or part of their family trust for other people. So we're seeing that happen more and more, and we help them set that up in a trust as well. So you can do it as a partnership or as a corporation. A partnership would be an LLC filed as a partnership. It could be a subchapter S company. It could be anything that has a K1 passed through it, or a corporation. They won't let you do it as a sole proprietor. So this is pretty much how it would flow, how you would set it up. The partnership would pay commissions to the disc. The disc, they would pay commissions to the partnership, and then it goes to the shareholders from there. The same with the corporation. You can pretty much see how this flows from the C Corp up to the IC disc and over to the shareholders. Pretty simple. But you have to set this up. Now, what the IRS wants to do is they want to make sure that you're basically the cost of goods sold for your U.S. company is similar to the cost of goods sold for your international company, because they don't want you to play any games by using one company that you set up and and hide a lot of profits, because your cost of goods sold is a lot lower there. So that's just kind of the things that the IRS is looking at. Therefore, there's a lot of analysis of your existing company and the company you set up, and the IRS would want to see your books, and they're going to make sure that you set your company up by a certain date, that you are paying out dividends and so forth, and they're going to make sure the math works.
Just to add a little bit higher level context, this is not a tax shelter. This is specifically set up so that U.S. goods can compete abroad. And essentially, you're taking advantage of the spread between the individual tax rate and the capital gains rate. So it's like any other arbitrage strategy. It's very underutilized because it's not really understood very well. It's kind of complicated to set up. It's definitely, I think, an opportunity, especially as more manufacturing comes back to America, potentially. It's definitely something that's underutilized that you might start to see gain more traction.
Okay.
So we threw this part of our presentation in over the last week. We decided we were going to do this. Obviously, because of the coronavirus, there's been major legislation, like we've talked about, the CARES Act, that's created new opportunities, and technically, the title of our presentation is Leveraging the Tax Code to Get Cash into Your Business, and this definitely falls into that. So everybody has probably heard of the PPP, the second tranche just got approved today. So I'm not going to get too much into the details. Very low interest rate, potential for forgiveness. Definitely, if you can get it, you should. one thing we're seeing, we're talking to companies every day that are applying in various parts of the country through various banks. A lot of banks are no longer accepting new clients. So you're going to want to try to go to your bank that you have a line of credit with or you have accounts with. The second one is, I think, less known. It's called the EIDL, the Economic Injury Disaster Relief Loan. So this is something that you can actually use to get a $10,000 advance. And it's normally for businesses in states that are, or in areas that are affected by like a flood or a natural disaster. But the whole country now, I believe, the whole country is now an economic disaster relief area. So this, you can get a working capital loan of up to $2 million. If you're a for-profit business, the interest rate is 3.75, and for nonprofits, it's 2.75%. A key feature of both these loans is it requires little to no personal guarantee or collateral, as you can see by one of the bullets here. So obviously, this is the government trying to say, it's unfortunate times, but they're trying to, they know that these businesses are going to be strapped for cash. So these are the things that are out there. I wrote this last night, this last bullet. SBA was not accepting any more EIDL due to lapse in funding. That's probably different as of this afternoon. So obviously everything is fluid, but if you're looking for funding, it's obviously, it's better to be there first than later. So that's something, if you have questions, reach out to your tax preparer, your CPA, or you can reach out to us and we can help you get the paperwork and stuff in order. So we talked about Nol Carry Backs. Again, this is very important. After the Tax Cuts and Jobs Act, it wasn't as beneficial to have a loss as a strategy, because of the tax cuts. They needed to increase revenue elsewhere. Anyway, you can go ahead now and for 2018, 2019, and 2020, create a loss and carry that back up to 5 years. So you're looking at being able to carry it back to the tax year 2014. So that means you can use the cost segregation, bonus depreciation, something if you're in the building sector, or it's called Section 179D credits, which deals with improvement or green components of a building that have been implemented. So you can use all these things to create a loss any year back to 2014, go back and get cash back into your company. So obviously you'd have to check with your tax preparer, your CPA to see if an NOL makes sense. All right, so that wraps up what we have for today. Again, R&D tax credits, definitely, I think the audience here, if you're not doing it already, you should definitely be looking at it. Happy to talk to anybody about it. Cost segregation, bonus depreciation, help create those losses that can be carried back and potentially get refund checks. Tell your friends, ask your questions to us. This is a time where we need to lean on each other as small businesses and as businesses in general. And we need to really figure out how to get after revving up the engine of this economy. So that's my closing thoughts. Senior, you got anything?
I just tell you that the IRS knows what's going on right now and has been ordered to help facilitate getting these treasury checks out quicker. And they, from my past experience, they will come out quicker now than they would have prior to the COVID-19 experience.
Sorry, I want to open it up for questions, but I want to ask you guys one question first. It has to do with the R&D tax credit. So if you guys have any questions, feel free to either type it in the chat or go ahead and unmute yourself, and I'll recognize you, or you can raise your hand. But Andy, the question I have for you is, a lot of companies are using the R&D tax credit, but what I've seen you do when you go into different places is you identify maybe they didn't fully take advantage of all the qualified research expenses. So can you talk to that a little bit about how some companies are maybe taking advantage of the R&D tax credit, but not fully taking advantage of it?
Yeah, great question. Yeah, so obviously the R&D credit has been pretty popular now for about 10 years. So CFOs and CPAs have picked up on, this is a strategy we need to be implementing. However, like I said, there's a lot of tax law behind it. And what happens if a company has a CFO or a CPA do it in-house, a couple things can happen. One, they tend to under quantify it just because there's not the breadth of understanding of the law and what expenses do and what activities do qualify. So, in the case that you're talking about, Gerard, they had severely under quantified their software development costs. That's because they were relying purely on an internal time tracking system. And when you do that, you tend to under quantify your credit because a lot of people, especially engineering type people, you tell them to track their hours. It's tough. They want to be solving problems, not doing hours entry. So that's why, we go in and conduct interviews with people and see how they're actually spending their time. The other thing that happens if you quantify that tax credit internally is the IRS prefers that there's an arm's length separation just to prevent perverse incentives, because theoretically you would have an incentive to pump up your R&D credit. So, that companies like ours provide that arm's length distance, an objective look. And yeah, so there's, we're always happy to look at tax credits that have been claimed, and you can go back and amend and claim higher credits. That's no problem, as long as it's an open tax year. And that certainly worked out, to the tune of over $1 million for the company Gerard's talking about.
Excellent. Brian, did you have a question?
I do. First of all, thank you guys so much for putting this presentation together. This information is extremely useful and helpful. I have a two-part question. Number one, it sounds like your organization can partner with companies to take care of a lot of this material and outsource it, because there's a lot that goes into it and it's confusing. And obviously I'm not an expert in it. I'm an expert in tech and not in all of this material. So is that understanding correct? Number one. Number two, what would that partnership look like if that is the case? What work exactly would you do for an organization like mine? And I guess number three, what would the pricing be? Is it a percentage of savings generated? Is it a retainer? Is it, how does that look?
Good. So yes, we work directly with you and, and your CPA to get all these things implemented. So we come in, whether it's an R&D, let's take, Brian, it sounds like I know the type of work you do would definitely qualify for this tax credit, right? So we would come in and conduct interviews, review documentation, and put together this whole report. We do it internally. It's not outsourced. I actually oversee the R&D department, so I'm heavily involved in operations there. So we help the CPA complete the tax returns, make sure everybody's got an understanding what's going on. Our fee is fixed. So we don't charge a percentage of savings. What we do is we work with you to provide an initial analysis up front for free. So we'll give you a range of what we believe your tax benefit could be, a low end and a high end, and we quantify what our cost would be, and that fee stays fixed. Generally we try to be conservative when we're doing that analysis, so that way, we get some gravy on top of what we were thinking going in. And that's certainly what happened in the case Gerard's talking about. Now, when we're going in, the R&D, that's like pretty standard repeatable product for us, right? So is cost seg. But when we go in and do an R&D tax credit study, we're looking at financials. Now, this is where the other area of our business comes in, which is more the unique financial and tax strategy consulting. So, we'll go in and see, oh yeah, the financial statements could be prepared a little bit better to show revenue in a different way. We'll know your business goals, right? So if you're looking to exit, there are things that you can do to improve EBITDA. And so we'll have a good insight into your company and be able to implement those strategies pretty easily. The fees for that are more retainer based, and it's more on a situational basis. And then, continuing with that analogy, should you want to exit, we could do a valuation of the company as well. Or should you want to buy a company, we can do a valuation of that company. That's another line of business that we have. Senior.
Andy, you've got for something you shared with me, when you go in and do that free analysis, right? And you come back and you say, hey, we think we can save you X number of dollars. You have some general ROI, certain ROI type numbers that you give up front, right? I mean, not precise, but at least within the range. Want to share? Can you share any of that information?
Yeah. So in our analysis, our initial proposal analysis will show you what your ROI would be. It's just your total tax benefit divided by our net cost to you. And, we try to get between 8 to 15 ROI. I think in a lot of cases that it can end up being 20 to 21 ROI. We certainly had some unicorns like that. But yeah, I've never really dealt with unhappy customers, which is great because you're getting them refunds, you're getting them lower tax burdens. And, I developed a relationship with these people. The R&D credit can be used every year. So there's clients that I've gone back to, and, I've gone out to dinner with their families, and we really pride ourselves on being able to build relationships with these companies and get a good understanding of their operations. So, yeah.
No, that's incredibly helpful. I really appreciate that. I don't want to take everyone else's time, but I'd love to have a call offline where we can explore this further.
I'll go ahead and set up an appointment with you and Andy, or maybe Kevin. Yeah, Kevin Gottlieb is on the phone with us. He's a GBA employee as well. Carlos, go ahead and unmute yourself and ask your question.
Hi, well, I'm Carlos. From El Salvador. However, we have a company based in Wyoming in the U.S. We are currently pre-revenue. We haven't invoiced as of yet. We're self-funded, and we're currently investing on the development of our software solutions. So how can this help us, or what programs could we qualify for?
Yeah, so you have a software solution that you're developing. Do you have payroll yet, or are you paying as an equity, or how are you paying people to develop software?
We have professional services development. We have a software developer based in Chicago and the other one based in England.
Okay, so we'll start with the one in Chicago. So any money you pay to him, let's assume that all he does is R&D to create this new product. Any money you pay to the third party in Chicago, you can take 65% of that towards a tax credit. So let's say you paid him $100,000. That means you're going to have $65,000 in qualified research expenses, which means you're going to have about $6,500 of R&D tax credits. Now you're pre-revenue, so you don't have any income tax. And you don't have any payroll. So you can So you can carry that $6,500 forward for 20 years. Okay. So, essentially what you want to do is build up a bucket, right? A lot of companies invest in R&D before they have taxable income. And prior to 2015, the R&D tax credit didn't make very much sense for them. But now you can use it to offset AMT if you're in an AMT position. You can use it to offset payroll taxes once you have them. And if you don't have any of those, then you can carry it forward and use it as soon as you do have taxable income. If you have other businesses, if you're a partnership or an S Corp, it flows through to your personal tax returns. And you can use a portion of that to offset income from other businesses. There's a weird formula that's kind of too complicated to explain off the top of my head. But like that $6,500, if you had no taxable income attributable to the business, you would be able to use it to offset a little bit of other income. I don't want to get too much into that. It's very, heavy in the tax mechanics. But the bottom line is, that tax credit could be carried forward, and you could eventually use it. Say you start hiring people next year, you could eliminate the employer portion of FICA payroll taxes.
Okay. And if we do, let's say, marketing initiatives and all that in the US, will that count into that?
No, marketing does not. Types of like secondary and tertiary activities to direct like coding and architecture development would be development of user requirements and user stories, user testing, beta testing, anybody you're paying to test. The sales and marketing and biz dev type activities are not qualified.
Okay, great. Thank you.
We also have any questions?
So if I could add, the IRS has done a lot of studies on the R&D tax credit, and they realize that the R&D tax credit being stored up in a bucket is forecastable. And they realize that over 90% of the situations that's used to offset new hires. And so that's why President Obama in 2017 strengthened it and made it permanent. It wasn't permanent up until 2017. So that's really interesting because now we have both political parties in a divided world very much behind the R&D tax credit. They're just finding ways to make it stronger all the time.
So I've been working doing R&D tax credits for like 7.5 years, and that takes you back to. So there was a kind of a shift before 2009. You really had to be discovering new information that kind of advanced the knowledge of a field. So that was called the discovery clause. And Brian, your work would probably still qualify for that. But In 2009, there was a series of tax court rulings and changes to the Internal Revenue Code, which created that 4-part test. And since I started working in this,
The discovery clause, so the 4-part test, let me see if I can pick that up, Andrew. The discovery clause was done away with in 2009 in an appeals court, which opened up those 4 tests. Those 4, and so now, if you can think about it, everybody that's doing any type of design is doing those 4 areas. They got stuff from sell, lease, or rent. That's a business component. They have uncertainty. They test it, and they really rely on it's technical in nature, which means it relies on the engineering sciences. So that opened it up to so many people. President Reagan actually invented the R&D tax credit, but we had fallen in 2004. We had fallen to number 18 in the world for R&D benefits as a country. So in 2004, they decided to do away with the discovery law and open it up with the 4 gates. The IRS challenged it in court, and they lost in 2009. So since 2009, many businesses are now qualifying for it that wouldn't qualify.
I remember what I was going to say. Since I started working here 7.5 years ago, every ruling and regulation that's come out has beneficial for businesses. So they've ruled on the side of the taxpayer, not the IRS. So that's just made it more and more feasible for companies to pursue this.
The Future of Money Governance and the Law is brought to you by the Government Blockchain Association, or GBA. The podcast brings together leaders in the public and private sector to discuss how government and industry can work together. We talk about how to enhance the integrity of our institutions and the quality of life for the people they serve.